What do I do with my investments? What do I change? Do we go to cash before things get worse? What's going to happen to my money? These are the questions that everyone wants to know the answers to. And what I wanted to offer today is the opportunity to help you answer these questions and share my process for investing. So in a sense, here's my guide to chaotic markets for you. Look at it, compare it to your process, steal it for yourself. I don't really care. I hope that this is something useful and hopeful to you during this really tough time. I'm going to be sharing my principles, and if we can talk like adults here, what I'm going to share probably won't sound good because we're in the thick of things here, but it might be what you need to hear. I'm going to be sharing what I believe are the core investment principles to get you to where you want to go, versus just pandering and telling you what you want to hear. So today, it's all about principles over pander. So let's get right to it. All right, there's two things that are true right now. The first one is that this will pass. And the second one, that's just as equally true, is holy crap, whatever. Okay? There will be an end, but that fact doesn't make it any easier right now. Over the past few days, I've spoken with a lot of clients, and they all share the same feelings that you and I probably feel: worry, anxiety, and fear. And the first thing I want to say is that you're not a bad investor because you feel those things. You're just a human. No one likes to see themselves lose money. Everyone can think rationally when times are good, but now it's real. Retirements, jobs, and family health is at stake. Okay, this sucks. So now what? Let's take a look at your investments. I'm going to share my investment process, and maybe this is a good time to review your own investment process at the same time. If you don't have one, no sweat. Let's talk about how to build one. I like to think of investing as building a house. We've got the floor, got the walls, and of course, we've got the roof. And right now, we're getting bombarded with a storm. Coronavirus, the economy, the markets are crashing, all this stuff is going on. That's supposed to be wind over there, in case you were wondering. So let's set aside the news for a second and let's refocus. I'm not trying to distract, just trying to take a second and look at this investment house that we built and ask ourselves this question: what was the whole point of this investing thing in the first place? And where we start is the foundation. Why? Why is the base? What were we trying to accomplish when we set out? You can also think of this as probably what are our values and what are our goals? For some of us, a value could be to spend time with our family. For others, a goal could be they'd like a $5,000 check to show up in their bank account every month during their retirement. Take a second to think for yourself, what are your goals and values? And you're probably thinking, Stephen, okay, why is this important? Because it's kind of the center for everything else, for building a great portfolio for you. All right, what's next? So next we got the walls. And those are the whats. These are basically just the tools at our disposal. So, we have stocks that we can use. We have bonds. Stocks are the risky stuff. Bonds are the conservative stuff. Maybe we have some Social Security and maybe some real estate income. So that's the what's. That's available to us. Finally, we get to the roof. And this is the how. How much should be in stocks? How much should be in bonds? What's the best strategy for taking Social Security? How do I not overpay the IRS? That's a big one. And how do we manage this risk? The thing is, all of these questions and the answers to them are influenced by your why, your values, and your goals. So if we don't know what we're doing or what the purpose is of investing, then we're kind of aiming at nothing here. And since I don't know what your specific goals are, I can't tell you what the optimal strategy is. But I can tell you that there is a strategy for each goal, and hopefully you have one. If you do, great. Remind yourself of it. You're going to need it in the midst of this chaos. But if you don't have a strategy, then what we're going through right now is probably making that apparent. For those of you who do have a strategy, let me remind you about your portfolio. A good portfolio has these components. It's low cost. And what that means is that you're keeping more of what you make. Maybe now's a good time to check on those fund expenses and see how much you're paying on them. Another element of a great portfolio is that it's well diversified. Now, diversification is kind of a big word, but what it basically means is that you give up on extraordinary in order to avoid terrible. So, for those of you who are diversified right now, you're actually not doing so bad compared to the market, contrary to what the news and the media are making you believe. Now, one thing diversification is not, it's not just picking funds based on their performance, say like in your 401k lineup. It's actually understanding which each fund's role is in your specific portfolio. So, say when stocks zig, they go down, your bond portfolio that's conservative actually does well. If you've built a portfolio based on your goals, then the amount that's exposed to the stock market is there for a purpose. It's built on the mighty weight of history, as Carl Richards says. So let's give an example of what this mighty weight of history is. So let's say you have a 60-40 portfolio. And what that means is you have 60% in stocks, 40% in bonds, or 60% in risky assets, 40% in conservative assets. Say you invested in this portfolio from way back when, 1972 to 2020. That portfolio has returned on average 8.75% per year. That means if you started with $100,000, you'd have $1.6 million by 2020. Now, let's look at what happened in between those two dates. In 1973, the market fell by 48%. In 87, it fell again by another 33%. In 2000, with the dot-com bubble, it was cut in half. And of course, we all know what happened in 2008. The market fell by a lot. And right now, we don't know where we're going to end up. But the cool thing is that embedded in this return are all of these drawdowns that the market has experienced over the last 30 or so years, 30, 40 years. So in your well-designed portfolio, this recent crash is embedded in there too. We knew it would happen, but of course we didn't know when or how. I really like what investment writer Morgan Housel says. He says the whole reason stocks perform so well is because you have to put up with stuff like this. It's the cost of admission. It's a feature, not a bug. But let's say, Stephen, I'm really worried and I just want to cash out. All right, let's walk through an example. So this next example that I'm going to do is real data, and I personified it as two investors, Bob and Sue. Both of them had $100,000 invested at the start of 2008. Now, Bob, he timed things perfectly, and he went to cash right before things tanked. And he hunkered down, and he stayed there. So he cashed out, and he earned kind of the cash rate for the next 12 or so years. Right now, he's sitting on $105,000, but he never lost a dime. Sue had a portfolio based on her goals. She had a college fund that she needed to pay for, and she knew she needed some money in retirement, so she knew she had to take some risk. So she invested in a 60-40 portfolio, 60% in risky stocks. Now, what happened to Sue is that she actually lost value in her portfolio when the crash happened in 2008. To be exact, she lost 30%. But that's actually less than what the market fell. The market fell a little over 50%. So the bonds in her portfolio actually did their job. So she didn't lose as much. But the good thing about Sue is that she hung in there. And over the years, her portfolio recovered. And now it's gone down a little bit in 2020. But even factoring in this most recent crash, her portfolio balance is at $195,000. So Sue has almost 2 times as much money as Bob. So cashing out can actually be more dangerous than owning stocks. All right, let's conclude with some additional hope for you. Whenever the market drops by 20%, it's actually up 12% per year for the next 5 years. Since 1928, stocks fall by 10% once a year, 20% once every 4 years, and 30% once every decade. Yet in that same time, your money would have doubled every 7 years. With all this as a backdrop, what are some action steps that we can do right now? First thing I'd say is review your goals. Review your why. Get centered back on that. And also, know the role of each component of your portfolio. It's extremely important that you have a reason for every asset class and investment within your investment portfolio. And finally, if you want some really good resources while you're sitting around at home, I have 2 books that I would really recommend. The first one is called Your Money in Your Brain by Jason Zweig. And the second one is called Devil Take the Hindmost by Edward Chancellor. All right, that's what I got for you. Thanks for putting up with my chicken scratch. And remember, you were here for the risk. Let's be here for the reward.